You're tuned in to Agriculture Today, and we start our Wednesday show talking about the One Big Beautiful Bill Act with K-State and Washburn law professor Roger McEowen. Roger, thanks for joining us today.
Well, good to be with you again, Shelby.
Roger, we've talked a lot about the One Big Beautiful Bill, but when did it go from being the One Big Beautiful Bill to being the One Big Beautiful Bill Act?
Well, when the president signed it into law on July 4th, so just a few days ago, really, and it became officially an act, and so now it's a law, and we know what we're dealing with.
And what are some of the biggest tax provisions we see in it for farmers and ranchers?
I think there's 3 or 4 of these. Of course, on the business side of things, the depreciation provisions are huge. We get restored 100% bonus, first-year bonus depreciation effective for qualified assets placed in service on or after January 19 of this year. And that is huge in terms of asset purchases and farm machinery manufacturers, those types of things. That's really going to drive and stimulate more asset purchases. And that would apply to a lot of farm assets. It applies to property that has a 20-year maker's life or less. And accompanying with that, we got an increase in the Section 179 write-off. The off-the-top allowance now goes to $2.5 million, and the phase-in kicks in at $4 million of qualified purchases. So once I have enough qualified purchases to get over the $4 million amount, I lose $1 of that $2.5 million write-off for every dollar I'm above $4 million in my purchases. Again, big deal for farmers. Another one that's huge out there is the qualified business income deduction. That's a 20% deduction off your business income. And so for a farmer, let's say they have $300,000 of farm income, that's a $60,000 deduction right there. So you put those 3 together, those are really big for many farmers that are out there. And of course, what was retained, it wasn't going to sunset, but what we had put in the Tax Cuts and Jobs Act starting in 2018 was a 21% corporate tax rate, and that stays. So we have a really good tax structure right now for business, and you're seeing this reflected in the stock market. We're sitting at all-time highs on the stock market right now. We've got the trade numbers coming in from tariffs, and that has exceeded all the economists' gloomy forecasts about that. Now, I was one in the past, and it's in my writings, that said this would not be inflationary, and it has indeed not been inflationary. So we got a pretty good business setting for our farmers, and then in the OBBBA, we've got a farm bill.
And what's in the farm bill?
Well, we've got. I want to focus on the commodities title, but basically we've got farm policy in place through 2031 and the 2031 crop year. And when you look at this, what they've done, if we go through this kind of sequentially, this is subtitle C. Well, it's actually the commodity subtitle of the bill, which is in Title I, and then you get into the various subtitles of that. They've got the nutrition subtitle that's in there, but if we look at commodities in Subtitle C, the reference prices for the major crops, the covered crops, have gone up significantly, and that's important because the payments, government payments, whether it's ARC or PLC, those payments are based on an effective reference price, which is based on a formula. And under the revised formula, the minimum price is set at 88% of the Olympic average price for the previous 5 years, and the maximum price can't exceed 113% of the statutory reference price. Now, that's higher than where we had been. And then the reference prices for the major commodities has been raised 11 to 21% across the board. Some are lower, others are higher, but they're all between 11 and 21% higher. So what that does is it increases the floor. So if the market price for commodities drops and it hits that floor, then you're going to get a payment. So they've raised the floor, which means they've increased the safety net. The reference price for corn is $4.10, wheat $6.35, soybeans is $10, and those are going to be the big ones in Kansas. And there's an annual escalator of 0.5% starting with the 2031 crop year, and that is capped at 113% of the new baseline, which is that original statutory reference price. And a couple other big ones with respect to that is that this year producers are going to get the higher of their ARC or PLC. No matter how they're signed up, they can get the higher of the two. And then starting next year with ARC, if they're getting ARC, ag risk coverage, if that's the way they're getting their payments, they can also get supplemental coverage option, which is a boost on crop insurance, which previously they'd not been eligible to do that. That if you're getting payments by ARC, you weren't eligible for SCO, and that starts next year. So really big stuff with respect to reference prices.
And while we're thinking about ARC and PLC, also a change when it comes to base acres?
Oh, this one is huge, too. This is a one-time voluntary opportunity for farmers as a whole to enroll up to 30 million new base acres based on their 2019 to 2023 planting history. This starts with the 2026 crop year. So the 2025 ARC and PLC are going to be continued to be based on the producer's current base acres with that increase starting with the 26 crop year. And there's a formula that's involved in terms of how many base acres are increased and then how the payments are going to be adjusted in accordance with that. But bottom line is the way this works for people to understand this is if base acres go up, that means you've got more acres that are eligible for payments, and with the reference prices going up, that's going to put more cash in farmers' pockets.
And another thing from this act, what about payment limits?
A big change here on payment limits. Historically, Shelby, any time that the farming operation is structured in any type of structure that limits liability, then you're only entitled to one payment limit. Now, the general payment limit has been $125,000 per person. So if I have an entity that limits liability, I get one person determination. So if you and I are in, for example, a C corporation together and we qualify for $125,000 of ARC or PLC payments, we split those. If we're 50-50 owners, we're going to split that $125 between us. We don't get two payment limits in that situation. That's changed under this legislation, because they create something known as a qualified pass-through entity. So there's been a number of us, and I've been one included, that's been pushing for this for quite some time, that we need to make the payment limitation rules match the tax rules. So if we have a pass-through entity, that should be treated like a pass-through entity for payment limitation purposes, meaning there should not be any one-person payment limit put in place just simply because you've got an S corporation that limits liability but passes the income through to the individual shareholder, or you've got an LLC that's treated tax-wise as a partnership, for instance. When I first started out practicing, one of the things that I was involved with was structuring farming operations to maximize farm program payments and working around that limitation. Well, that limitation's gone now, finally. And that's going to simplify things from an estate planning standpoint. That makes things easier, and it lines things up with the way we do, the way these entities are treated from a tax standpoint. So that is big. That's a big development.
Do farmers and ranchers need to worry about anything sunsetting in this act?
Well, these provisions are generally good through 2031, and then it'll change. So we've got some time here to work with this. So it's not like we're up against a one-year authorization and we're going to do that and then reauthorize it again. This is policy that's set for a period of time now. So that's pretty good. From a planning standpoint, I think this helps. And as I talk to CPAs and attorneys that represent farm clients, this really helps the planning horizon because we've got the policy set in place that's going to be here for a while. It would take an act of Congress to change it. And, of course, they can always do that. But once this gets in place like this, they're not going to change it. So we know where we're headed from a farm policy standpoint for a number of years.
As you've talked through a bunch of different things today from this act, what are the key points you really want to hit home for farmers and ranchers and those helping farmers and ranchers?
I think the key point here is that the Congress has really strengthened the safety net by increasing those reference prices, by giving them this year the higher of ARC and PLC, and by some changes with respect to crop insurance too, which we didn't talk about, but they've made some changes there. And an important change in the adjusted gross income computation. Now machinery gains will count as farm income, and that is a very important change. I was in a group of about 4 of us that had been pushing for a number of years on FSA to get that done, and they had refused. Well, Congress is now forcing their hand. And that's important because once you clear a 75% threshold with 75% or more of your adjusted gross income coming from farming income, then there's a couple of other limitations that drop off. And that's going to be very big because now a lot of farmers will have income from the trading of farm equipment, which is now treated as a sale on Form 4797 under TCJA. So they've corrected that problem. But bottom line, safety net has been enhanced, and this is a lot of dollars going into the sector, probably somewhere between $50 and $60 billion have been specifically tied to that farm safety net, and that's a big deal.
Roger, I appreciate you taking the time to join us today.
Thank you, Shelby.
That was K-State and Washburn law professor Roger McEowen. I will link his article that he wrote on this topic in today's show notes on agtoday.net, or you can also find it by going to agmanager.info.